Good morning to all. This is Araby Madbouly. I am the head of business and accounting department, Muscat College, Sultanate of Oman. I'd like to thank the organizing committee of IMCCRT-2020 for organizing this committee at this pandemic time. Today, if you permit me, I'll present my paper titled Determinants of Banks' Credit Risk, Conceptual Perception. I have other colleagues, two co-authors, Dr. Gopalakrishnan Chinnasamy from Muscat College, Sultanate of Oman, and Dr. Abdelbaset Queiri, again from Muscat, Oman Tourism College in Sultanate of Oman. Okay. As I mentioned, the title of our article is Determinants of Bank Credit, Conceptual Perception. Actually, it's worth not to say that the banks are one of core, the banking industry is one of core activities in the economy. As we know, the main role of the bank is to be intermediary between the savers and borrowers. So the credit is the main source of the bank, the main source of income of the bank. And when the banks go to provide credit to borrowers and also through the different operations of the bank, they have some risks, such as credit risk, which you are studying today, the marketing risk, and other operational risks. So some of these risks have very important impact on the performance of the bank and its profitability, which means these risks may affect the sustainability of the bank itself. And we have many international cases during the financial crisis 2008-2009, and we saw what happened to Citibank and to other huge banks when they have collapsed. Okay, so the credit risk is deliberated as one of risk challenges in the commercial banks, as it's more complicated than other risks. Okay, the importance of studying the credit risk has increased, as I referred, after the 2008-2009 financial crisis, and they considered that having credit risk may lead to, or may the factors which lead to a banking crisis, which is one part of the overall financial crisis. As we know, if we have banking crisis, we may have exchange rate crisis, and we may have financial crisis, which all together work as a comprehensive financial crisis. So researchers started to feel the importance of studying the credit risk. It became one of most important topics which researchers started to identify it, try to understand what are the factors which affect this credit risk. From here, many studies, many literature came to understand what are the determinants of financial, of the credit risk for any bank. As the credit risk become, as I mentioned, as a vital matter to attain the bank's stability and manage the risk effectively. From here, we started our research problem, as the credit risk become a major issue affecting the international banking. So here we can say that the main problem of our research is that we have many risks. Credit risk is the most important one, and it has a major influence on the bank profitability and bank sustainability. Therefore, identifying the causes which enable us, the causes of this credit risk may enable us to prevent this credit risk extremely, and which may lead to improvement in the overall banking sectors. So the main aim of our research is to explore the credit risk determinants for banks. We have two objectives. The first objective is to explore the macroeconomic factors influencing the credit risk of banks, and the second one is to explore the bank-specific factors influencing the credit risk of the bank. The two objectives are related to two research questions we have. What are the macroeconomic determinants for bank credit risk, and what are the bank-related determinants for the bank credit risk? Our research is only conceptual. We tried to identify. We reviewed huge number of literature and classified them into many groups to find the theoretical framework at the end for the macroeconomic and bank-related factors which impact the credit risk significantly. And what the direction of this relationship? Actually, we went for this one. We did not want for a measurement or application of this theory. We only surveyed the literature, and our final framework is a comprehensive framework about the factors which affected the credit risk for different banks. In this regard, we started our literature review. Our literature review section it's the core, it's the backbone of the study. We started by background, definition of credit risk, source of credit risk management, or the meaning of this, and empirical study and theme-based factors influence the credit risk, even macroeconomic or bank-specific factors. Simply, the credit risk is the potential that contractual party will fail to meet its obligations in accordance with the agreed term. Simply, we can say if I have a loan from a bank and I am not able at one point of time to pay my obligations toward the bank, this is for the bank, this is a credit risk, simply. So it indicates the probability of a bank to suffer loss. If I have a loan and I did not pay, then the bank will suffer from loss to load their credit assets due to a single or comprehensive influence of certain factors, which is called, this is the credit risk as per Van and Van 2019. However, what are the credit risk management? Credit risk management refers to the sum of policies and procedures that the bank can follow to avoid going into this problem. If the bank has a proper credit risk management, it will avoid going into high credit risk, avoid going into non-payables from its borrowers. Having successful credit risk management will enable the bank to achieve high level of profitability, sustainability, and will avoid the overall economy to run into a bankruptcy or banking crisis. What are the sources of credit risk? Actually, many sources we have for credit risk according to many, we have hundreds of literature in this area. Okay, simply we can say that the source of credit risk can be related to the poor management, unfitting credit policies, ineffective laws, poor control procedure, tolerance credit, and many. Insignificant loaning practices, insufficient supervision of the bank, and so on. Okay, other factors are defaulted loans, namely, okay, the inappropriate bank distribution, loan distribution on its borrowers. Okay, so many sources of credit risk we have. The question, and this question is the core of our study. What are the factors which influence the credit risk in any bank? We have classified, as per the literature found that two main factors, macroeconomic factors and bank-specific factors. We'll go and study each of them, and we'll see how each of these factors impact the credit risk of a bank. The first one, macroeconomic factors, we have 5 factors: real GDP growth, oil returns, unemployment rate, inflation, and interest rate. For the bank-specific factors, we have return on equity, ROE, capital adequacy, loan growth rate, and income diversification. Let's go to study each one of them and what are the conclusion at the end. Okay, the first factor is the real growth rate and how it impacts the credit risk of any bank. It's by logic. If I have good growth rate, high growth rate, this means that we have high earnings, which means again that the people will be able to serve the debt. It means that the credit risk will be less. Simply, all literature in this area found one outcome. It's that the relationship between real GDP and growth rate and credit risk is a negative relationship. As per Big 2015, Louise's 2012, Nokus 2011, and many other literatures. The second one is inflation rate. That the inflation rate has a positive or a negative relationship with the bank credit risk. Actually, there is a positive relationship, which means if we have high level of inflation rate, we will find high level of credit risk. We will find people will not be able to repay their loans. We'll find the banks will not be able to collect its payables from outside, receivables from outside. So which means that higher inflation rate will lead to higher credit risk in the banking system. The variance of credit risk level among banks will make banks with a higher level of risk more vulnerable to the overall economic distress. The third factor, the third macroeconomic factor is the oil returns. The literature found a negative relationship between oil returns and credit risk for oil countries. Many studies went to investigate this relationship for Gulf countries and other oil producing countries, and they found that this relationship is negative. However, some other studies found a direct and other found indirect impact of oil returns on the credit risk. For sure, the most concerning countries in this are oil producing countries. The fourth one is the interest rate. Interest rate is another important conditioning factors impact the credit risk for any bank, which means that the effect of interest rate on a credit is expected to be positive. High interest rate leads to more probability of non-payment from borrowers, which means high credit risk for any bank. Increase the high interest rate lead to increase in the debt burden, which lead to high risk of non-performing loans. So according to this, the relationship between interest rate and credit risk is positive relationship. The last factor affect the last macroeconomic factor affect the credit risk as per the literature is the unemployment rate. And actually the relationship is a positive. When we have higher level unemployment rate, for sure you will find many of the population lose their work, lose their income. So there is a probability of non-payment from their side, which means more or higher credit risk for the banking system. These are the macroeconomic variables which impact the credit risk for any bank. The other group of factors as per the literature are bank specific factors. There are some, the first macroeconomic are related to overall economy. These are related to each bank and they are different from one bank to another bank according to its policies. Actually, the first factor affect the credit risk is the return on equity. ROE has no significant effect on non-performing loans. Non-performing loans are the indicator which we use to determine the level or to measure the level of credit risk. Okay, so while it has no significant effect in some literature, others found a negative correlation between non-performance loan and ROE. Long growth rate. The long growth rate presents a fundamental task in controlling the degree of credit risk. Loan production process has a direct positive influence on the degree of credit risk. So long growth rate, higher long growth rate means more or higher credit risk for any bank. The third factor is capital adequacy. Capital adequacy ratio has a positive significant impact on non-performance loan. So again, there is a positive relationship between capital adequacy ratio and the credit risk for any bank. Finally, income diversification. Income diversification has a negative relationship with credit risk for any bank. Definitely, if the bank able to diversify its income resources, then the credit risk will be less. It will be able to manage the liquidity or to have liquidity from many sources, so it will be less credit risk. Finally, we found the final conclusion from our study that we found that this is the conceptual framework which can be used later for any empirical study to identify or to measure the determinants for credit risk, even for one country or for cross-section countries. The macroeconomic and the bank-specific variables. The bank economic, as we said, real GDP, inflation rate, oil returns, interest rate, and unemployment rate. For the bank-specific factors, ROE and diversification, income diversification, and capital adequacy and loan growth rate, as I referred. Okay, this is the conceptual framework of our literature review. This is the final outcome which we have. So the bank, now we found the factors we found the factors which impact the bank credit risk, and this study has empirical impact. Its impact or implication, it highlights the importance of collaboration between the bank management and monetary regulatory bodies to minimize the credit risk ratio through strict rules and regulations. Actually, the implications of this study can be used by even monetary policy makers, monetary policy designers, central bank, or by the bank management itself to avoid going into a bankruptcy or going into an overall banking crisis. Okay, thank you so much. Thank you again for IMCCRT organizing committee, and hope inshallah to that this presentation being useful, and thank you so much.